Well, good afternoon, everybody. I'm Eric Levinson with Vena Capital, and welcome to our 2025 Outlook webinar. Now, what we'll do today is, like normal, we'll have presentations from our Chief Economist, Michael Kokolari, from our Head of Research, Lin Vu, and then we're going to do something a little bit different from the panel. Oftentimes, we get questions on products, so we'll keep Mike because we know that there's a lot of questions on macro, and then Con Vu, Portfolio Manager from VOF, our Vietnam Opportunity Fund, and Tu Nguyen, who's our Head of Listed Equities, who manages our UCITS fund and our local fund, will join Mike for the panel discussion. So before we get to the presentations, let's do a quick review of 2024 and then kind of give ourselves a report card. So what we always do is we want to say, well, what did we forecast in prior year and how did we do? Do we have the credibility as you think about what we're forecasting in 25? We think about it from what we got right, what we got wrong, and what we didn't foresee. So let's go through this quickly. So what we did get right is we forecast a recovery in the manufacturing sector, and that certainly drove Vietnam's GDP growth. Mike will talk more about that later. We forecast that a strong U.S. economy would really drive that rebound in exports. That absolutely happened. We continue to forecast very modest inflation, so we're right there. We did continue to forecast robust FDI investment. We forecast that the real estate recovery would begin. We think it's picking up steam. We'll hear more about that from both Michael and Lin. We forecast that interest rates, which are still low, are starting to creep a little bit higher. And then finally, something where we give ourselves a yellow light, we talked about there being a recovery in the consumer. And while that certainly started to happen in the second half of the year, it didn't happen, let's say, kind of as strong as we would have liked or forecast. So we're going to give ourselves a yellow light on that. Now, what did we get wrong? Well, the Vietnam dong depreciated about 5% last year, and it really picked up in the second half of the year. That's not something we thought was going to happen. We didn't actually think that Vietnam would have a trade deficit in the second half of the year. That's quite surprising. And then finally, we did think that we'd also have better stock market performance in the second half of the year. The market actually ended up okay, but kind of the second half of the year, particularly in the fourth quarter, it really kind of struggled to finish strong. And then finally, we did forecast stronger growth and stronger pick up the pace in infrastructure spending. That was really flat, and we do think we'll talk more about that later on. Now, what didn't we foresee? We didn't think that we'd see net foreign outflows to the extent that we did at about $3.6 billion for the market. We didn't see, and this is kind of a positive thing we didn't see, really an accelerated reform agenda that's coming from the new government leadership team. Both Michael and Lin will talk a bit more about that. And then finally, we didn't forecast a depletion of FX reserves below 3 months worth of imports. That's something that we kind of look at as a benchmark to think about, are the foreign reserves enough? Mike will certainly speak more about that. So that's the report card on kind of our forecasts. Now, importantly, let's go to the report card on hopefully what you really care about, which is our performance. Have we delivered to our shareholders, and did these forecasts impact, importantly, our performance of our funds? Well, as you can see, across the board, we continued to deliver outperformance. The Vietnam Opportunity Fund, our London-listed closed-end fund, returned in 2024 10.2%. That's compounded in USD versus the index of 8.8. 3-year return outperformed by about 600 basis points, then 5-year of 10.9 versus 5.4. When we look at VVF, our UCITS fund, that's Article 8 as well. Last year up 16.7 versus 6.8. 5-year return 13.4 versus 3.7%. So almost 10% alpha each year over the last 5 years. VAF, which is our Cayman feeder, that feeds into one of our local funds. Last year up 15.5 versus 6.8. 5-year return at 14.7 versus 3.7. So across the board on all of our international funds, we've outperformed in a consistent manner. As we look to our local funds, VEOF, which is primarily mid-cap and large cap, at 24% last year versus the index at 12.1. This is in local VND terms. 5-year return at 16.3 versus 5.7. VSAF, which is more small cap in nature, last year at 22.1. 5-year return at 20.4% versus 5.7. So yes, that is a correct figure. The average annual return 20.4%. It's the number one 5-year performance in Vietnam. And then VMEF, which is the Modern Equity Economy Fund, which we launched in 2023, was the number one performing fund in Vietnam at 34% last year versus the index at 12.1. And so again, whether it's 1 year, 3 year, 5 year, or inception, the portfolios have done an incredible job. Even our balance fund last year at 17.9%, which is 50% equity, 50% fixed income, versus a blended benchmark of 8.4, actually outperformed 100% equity benchmark. So as we think about our commitment to our shareholders, to our partners, to our clients, we had a lot of happy clients last year, and we expect a little bit of a bumpy ride in Q1, which Michael and Lynn will certainly address. So as you think about Vena Capital, our commitment to deliver performance, we certainly are proud of what we've been able to deliver. Khan and Tu will be up on the panel later today if there's any questions. So with that, I'll transition to our chief economist, Michael Kokolari, to give his outlook on the economy.
Thank you, Eric. Okay. These are the topics I'm going to cover today. So the first topic is about Vietnam's economy this year in 2025. Now, last year, 2024, the main factor that drove Vietnam's GDP growth was exports to the U.S., in particular, exports of high-tech products to the U.S. that grew about 40%. So this is the main thing that pushed our GDP growth last year. Now, in addition to that, we also benefited from the tail end of the post-COVID tourism reopening boom. So we still had tourists coming back last year. Tourism arrivals last year were also up around 40%. That having been said, that boom has now finished. The number of tourists that came last year is back to pre-COVID levels. So that's not going to boost the economy this year. And also, the big boom in exports to the U.S. is going to dampen out. And I'm going to talk a little bit more about that. The key point that I want to make on this slide is that we are going to transition this year, in 2025, from having been the growth being driven by external and exports to being driven by domestic factors, consumption, real estate, and infrastructure. And I'll talk more about that. But the key point here I want to make up front is this is actually a very good story for investment opportunities. When we think about it, I just mentioned last year, the big growth driver was this high-tech export boom, okay? Who benefits from that? It's really primarily the FDI companies that capture most of the economic value of that, Samsung and the suppliers of Apple, et cetera, because they're the ones that are producing the products. Of course, the overall economy benefits because they hire workers, the workers get salary, they spend that salary in the economy. So of course, the overall economy benefits, but the primary ones that capture that economic value of the export growth is the FDI companies. But this year, we see a lot of interesting opportunities in both the PE sector and listed companies, listed stocks coming up, because who's going to benefit from domestic-driven growth? Well, it's the local companies that are here. So that's the big picture that we want to set the frame up front. To understand a little bit more about the dynamics and specifically what we expect to happen this year, we need to take just a very little quick review of this export story the last couple of years because it will be very relevant to what we expect for this year, 2025. What you can see up on screen here is we've had big swings in the export growth to the U.S. the last couple of years. I like to think about it as kind of like a spring and a weight. If you have a spring and you drop the weight, it makes a big drop and then a bounce back and then another drop, and it kind of dampens over time. And you can see that sort of a pattern with these numbers up here. And remember that what happened in COVID is, exports shot up of stay-at-home goods, and then what happened after that was the retailers had too much inventory, so they cut their orders, but then they destocked too much. So so there's this kind of spring thing that happened over time. And what we're expecting for this year is to normalize back to, in other words, the spring effect has kind of dampened out. Now that spring effect is related to something that the supply chain people call the bullwhip effect. And the idea of the bullwhip effect, and this happens over and over in the economy and global trade, the idea of the bullwhip effect is companies will, when they perceive customer demand sort of picking up, they will often extrapolate forward and think like, okay, this demand's going to go up forever kind of a thing. And long story short, there's a tendency that happens, and this is a very well-studied phenomenon, for those companies to overorder, and then you get this kind of trickling effect over time. That's kind of represented on this graphic. This graphic is from a logistics company, so these guys are always dealing with this kind of phenomenon. Now, what happened during COVID is you had this normal bullwhip type effect that always happens over and over. And then what exacerbated that is you had the supply chain disruptions. Remember, what was happening at that time is companies couldn't get their products that they ordered, so if they needed like 5 of something, they ordered 10. And so long story short, this kind of spring type effect got exacerbated by the overordering during the supply chain disruptions. This is all important for 2 reasons. The first reason is that these 2 slides are slides that I had in this webinar at the beginning of last year. And the reason I put these up is for 2 reasons. First of all, I want to mention that we really had the most accurate forecasting track record over the last 5 years for the GDP growth. And the reason why is we really tracked things from what would be called a systems dynamics point of view. And that's a fancy way of saying this spring kind of moving up and down. We looked and we saw the inventories got too high during COVID, and then they got too low. And so because we knew the inventories were too low, that was what guided us to predict the surge in exports to the US last year. Normally, economists look at things from what's called an econometric point of view, or like extrapolation using linear models. And and I say we because it really was both our late CIO, Andy, who had studied at MIT, studied system dynamics at MIT, and I'm kind of have more of an engineering type mind. So we were looking at things from this point of view. So I'm mentioning this partially to pat myself on the back that we got things very right those last couple years, but also because I don't think still, even now, people have really understood or recognized that this was the primary economic dynamic the last few years, and including this year, 2025. I was on a panel back in 2022 with some really fancy type PhD, World Bank type guys, et cetera. And at that time, 2022, they were throwing around this forecast that we're going to have another good, strong year of manufacturing in Vietnam. And I said, well, no, you can't because of this whole inventory up and down story. And what I see this year, 2025, is I see some very big forecasts for GDP growth this year floating around. 8% growth, 9% growth, 10% growth. To put those kind of numbers in context, 10% growth is like how much Japan's economy was growing during its heyday in the rebuilding after the war, all right? So these are very hard numbers to achieve for a country that's already Vietnam size. So on the one hand, we have these kind of very big forecasts that are floating around. And on the other hand, I don't think there has been, even now, an understanding or recognition of this kind of spring dampening effect that's about to unfold for this year. So long story short, what I'm expecting for 2025 is that our export growth slows, and it's not because of Trump or tariffs or anything like that. It's just because of the math of the system dynamics, the spring type thing. So let's say we come into Q1 and things are starting to slow, and at the same time you have these very big forecasts. See, I think what's going to happen is that the policymakers are going to look at this setup, very big aggressive forecasts, economy slowing more than they expected, and they're going to look at the 2 dials that they have that are the easiest way for them to pump up the economy. And those 2 dials are, first and foremost, infrastructure spending. Now, the government has mentioned a target of something like 20% infrastructure growth in infrastructure spending this year. That's very encouraging. And based on my kind of prediction for this year about the 2 dials, my take on that is 2 things. First of all, we often get big forecasts, from the government. We're going to go up this %, and it doesn't always happen. This year, it is going to happen. And I think you could even see, them going past their forecast and growing at 30%, for example, is feasible for this year. But that having been said, infrastructure is only 5% of the economy. So if you think about a pie and you have the slice that's like a 5, if they grow that 20%, of course, that's very encouraging. But a 20% increase on something that's only like a 5 out of the pie, that would only add 1 percentage point to GDP growth. So that won't be enough to offset the slowing export story. So that's one of the dials, infrastructure spending. And then the other dial is real estate development. And the good thing about real estate development is that you would not only boost that economic activity, but you would make people feel more enthusiastic and more confident to spend money. Because at the end of the day, the best way to support the economy is to make consumers feel more confident and spend more money. Consumption is over 60% of GDP. Last year, we saw that there was a steady improvement in consumer confidence as the year progressed, especially towards the end of the year, as Eric mentioned. And what my belief is that by pumping up, taking steps to pump up the real estate market, that means faster approvals and a bunch of other things we've talked about before, that will make people feel more confident. I first mentioned this idea in our investor conference back in October, and you can actually find the videos that are still there. And I think it seemed to be quite good. We had very, very high views on that, so people seem to find that information useful. At the time that I did that presentation back in October, I presented this sort of idea. I did it a little bit different. I had a decision tree of this happens, that happens. But one of the things I mentioned in October was that at that time, I said, this is my prediction for 2025. And I said that it's not a consensus view. I said it's about 50-50, the people that I talk to. Some people agree with my idea, and other people think it won't be possible to get the real estate market moving. And now what I see is that really my view is starting to become more consensus. And some of the words that I use, things like wealth effect, et cetera, are popping up in different people's reports. So this is gradually becoming the consensus. And I think what you'll see happen is if we do get a slower than expected GDP growth print in Q1, then this will really become the consensus. Because again, those are the only two knobs they have to really kind of support the economy, given the backdrop of very aggressive forecasts, and also given the backdrop of perhaps not really fully understanding this whole spring dynamic as it plays out. So that's basically what we're expecting for this year. Better consumption, slower manufacturing, big pickup in construction, because based on what I just said, you're going to get more construction from both infrastructure and real estate development. So this is kind of the snapshot of how we see things this year. And again, I think it will be a very good backdrop for investing in PE companies and listed companies. So a lot of companies will be sector specific. And Leonard, head of research, is going to talk more about that. So that's my overall view. The other topic that we really have to talk to that's very important, of course, is the Trump's election and what impact that could have on Vietnam. Now, after Trump was elected, there were a number of newspaper articles that were, in my view, way, way overly pessimistic. There was one very prominent publication, I mean really prominent publication, that was essentially saying that Trump being elected, boom, was going to hit Vietnam's economy harder than COVID. And you just think about that. That's absurd. It doesn't make any sense, okay? And someone wasn't using a calculator or something. So there was too much pessimism about the potential impact of Trump and his tariffs and all this kind of stuff on Vietnam. The reality is that the U.S. needs Vietnam. The U.S. has put themselves in a position, whether they intended to or not, where they are dependent on importing consumer products. The U.S. is a consumer consumption society, and so they need to import the products, and Vietnam is the most obvious place to import them from, I believe. And we'll talk a little bit more about that. So this is the hype. This is the reality. Lots of, again, very, very overly pessimistic headlines. But the reality is that when you look across a wide range of consumer products that are purchased in the U.S., this is the percent of those products that are imported to the U.S. So for consumer electronics, 95% of the consumer electronics products that are purchased in the U.S. are imported. And of course, Vietnam is a significant player in most of these categories, particularly in consumer electronics, okay? So the idea that the U.S. could reshore the production of these type of products, consumer electronics, is never going to happen. It is absolutely not going to happen. The wages in the U.S. are too high. The availability of skilled workers is too low. I've spoken in the past about this recent, there's a kind of an interesting A/B, what scientists would call an A/B test, where the TSMC semiconductor fab, they set up a fab in Japan, and they launched a fab in Arizona at the same time. And I've mentioned this before, that they couldn't get enough good engineers in the U.S., and et cetera, et cetera. So it is not possible to reshore the production of the types of products that are made here in Vietnam. And when we use that word, not possible, now we have to a little bit shift gears in our thinking to what a type of thinking that the political scientists would call realpolitik type thinking. And the idea of realpolitik type thinking is that countries, at the end of the day, countries do what they have to do. They don't do what they want to do. They do what they have to do. You know, Trump and everybody may want to reshore production to the US, but they can't. It's not possible. Germany may want to, you know, wean themselves off of coal and blah, 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 that kind of stuff. But the reality is Germany is restarting its coal production. So countries do what they have to do and not what they want to do. That's the first kind of realpolitik type framework we have to have in our mind. And the second framework we have to keep in our mind is particularly for the Western countries. We need to keep in our mind when we're thinking about analyzing the reality of the current situation, is that the policymakers, particularly in the West, the policymakers will telegraph to you, will communicate to you what the current plan is and what the current thinking is of the direction that kind of the upper tier elites see the country moving into. So I mentioned earlier that we were really the only ones, I was really the only one to forecast the spring effect for the GDP growth the last few years. And I also had a very good track record of forecasting what happened with Vietnam during all the trade war developments those last years. Probably people might not remember, because this is a couple years ago, but when Trump was first elected, there was a lot of hysteria and concern in Vietnam that this was going to be bad for Vietnam. I think I was the only one, or the first one, to say, no, this is going to be good for Vietnam. When Biden was elected, same thing. There was a lot of panic. You know, maybe Biden's going to be good for, you know, nicer to China, et cetera, et cetera. And the way that I was able to forecast the way that things were actually going to play out, you know, my secret sauce, if you like, is I just read very carefully what all those policymakers were saying in, you know, if you read the Brookings Institute, if you read the Atlantic magazine, you read the CFR, FP, the Financial Times, FT, you read them very carefully and watch what the policymakers are telling you, because they are trying to gather consensus when they're sending these messages out. They're trying to get the alignment of Wall Street and company CEOs and, you know, et cetera, et cetera. So anyhow, long story short, you do that and you find the direction that things are going in. And the direction that things are going in right now in the US is very clear. They use a fancy term. They say China is a near-peer competitor to the US. So what the policymakers are telling you is that China is the focus, not Vietnam, China. And also, this is something I pointed out as well in the past, this idea called the New Washington Consensus. And I had pointed this out before because the point there was to say it didn't really matter whether Trump was going to get elected or Harris was going to get elected. This is the focus. They had already had this, you know, there was a lot of signs that this is what the focus is. So the focus is on China. And then in recent weeks, what we start to see more and more, again, by watching those, you know, key publications where they communicate what the, you know, what the upper tier policymakers are thinking, is that there's more and more focus on this idea that there's too much Chinese influence in Mexico. Too many factories, too much political influence of the Chinese in the government and this kind of stuff. Some of these articles are literally from 1-2 weeks ago, okay? So the policymakers are telling you very clearly that this is the focus. The focus is on China and on Mexico. And actually, what the policymakers are communicating to you here is also can be seen in the markets. So you know, when you have those two together, then you really know, like, this is what's happening. So what I have here on the screen is the value of the Vietnam dong and the value of Mexico's currency, and from the starting point of July 14th. Because July 14th was the assassination attempt, and I think it was really clear, that was the time it became clear that Trump was going to win the election. And so if you look at what happened to the Mexican currency after it became obvious that Trump was going to win the election, that the value of their currency has depreciated by, you know, it's headed towards a 20% depreciation. The dong has had some fluctuations up and down. I'll come back to that in a second. But basically, you can see on the chart, the dong is essentially unchanged from the time that it became obvious that Trump was going to win the election. So what the currency market is telling you is that there's going to be big tariffs on Mexico, and there's not going to be big tariffs on Vietnam. So that's what the policymakers are telling you, and that's what the currency market is telling you, and that's what I believe, because that's what they're showing us. And now let's think this through for a second. Trump 1.0, Mexico and Vietnam were the two biggest winners of Trump 1.0. But everything is showing you that Mexico's out of the picture. They're not going to benefit from Trump 2.0, okay? So I'm very confident to say that not only will the Vietnam not get hurt by Trump 2.0, I think it's going to be more of the same. This is a chart that kind of summarizes, what's happened since the first trade war. This chart shows you trade corridors in the world. And so the most growth of any trade flows in the world have essentially been China exporting production materials to Vietnam. Vietnam makes the final products, exports them off to the US. And then the chart on the right, this is for a specific product, which is routers and modems and this kind of thing. And what you can see here is that this is the proportion of those products that the US imports that used to come from China. So China's market share has dropped by 35 percentage points, and you can see basically Vietnam and Taiwan and Thailand have picked up the share. And this, the chart here on the right came out a couple weeks ago from the Hinrich Foundation. So I want to give a shout out to them because I think their work is very good. But that having been said, I've had different versions of this whole chart like over and over the last 5-6 years because this is kind of what the story has been. So conclusion of all that is that I do think that Vietnam will come out okay from the Trump. Maybe not benefit as much as during Trump 1.0, but I think we're in for another good period. And the last thing I want to touch on is that all that having been said, the concerns about Trump tariffs are one of the factors that's pushing up the value of the dong. Also, I mentioned at the beginning this kind of roller coaster idea in the spring of the exports. Well, the export growth slowing together with what's going on with the dollar, this will continue to put depreciation pressure on the dong. So I do expect some more depreciation pressure on the dong in the first part, particularly in Q1. So you'll have this kind of confluence of depreciation pressure on the dong, and also slower exports, slower GDP growth in the beginning of the year, followed by towards the end of the year. I think what's going to happen, and this can be a whole other webinar discussion by itself, is that the actions that Trump has an amazing economic team around him. J.D. Vance, Scott Bessent, Steven Murin. This is the best economic team since Bill Clinton time. So they have this strategy that everything they want to do entails having to bring down the value of the dollar. The dollar is overvalued by 25–30%. So all this idea of reshoring and blah, 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 that's not possible with the dollar where it is. So they have this strategy to try to use tariffs to bring down the dollar later. I could talk more about that in the Q&A if anyone's interested. But long story short, so what the summary of everything that I'm talking about here is I think you see depreciation pressure on the dong in the beginning of the year, pressure on the GDP growth in the beginning of the year, but then by the end of the year, you see that the GDP growth is picking up because of more domestic stimulus, and also that the dong stabilizes. Perhaps will depreciate by something like 3% next year as the value of the dollar comes back to earth, basically. Okay, so now you've seen my picture on how I expect things to progress with this year, the transition from export-driven growth to domestic-driven growth, this kind of roller coaster we're expecting for both the economy and the Vietnam dong. And so next, my colleague Lin Vu, who's the head of research here, is going to splice it together how this connects with what we expect to happen with the stock market. So I will hand it over to her next. Thank you, Lin.
Thank you, Mike.
All right.
Hello, everyone. Today, we will discuss 4 main topics. First one, we will review the stock market performance in 2024. Second, we'll look at the factors that drive the markets in 2025. Then we will share our view on earning outlooks of 2025 and valuation. And last, we will discuss about investment theme. Stock performance in 2024. 2024 was a year of mixed fortunes across global stock markets, with developed and emerging markets showing divergent trends. Vietnam's stock markets demonstrate resilience, achieving a return of 12.3% in VND terms and 6.8% in US dollar terms. This performance placed it stronger than emerging and frontier average, and also better than Thailand, Philippines, Indonesia, and South Korea. The markets that benefited from tech trends such as the US or Taiwan generally performed significantly better than others. Looking back on 2024, compared to the past 4 years, 2024 was relatively stable. We think the markets performed really well in the first quarter, but struggled to surpass 1,300 level multiple times. The last year was a year of significant events that will shape the development of the stock markets. In Vietnam, Nguyễn Phú Trọng, the long-serving general secretary of the party, passed away. In the US, Donald Trump secured another term in office. Investors in Vietnam reflected negatively on both events. However, since the new general secretary of the party, Tô Lâm, took his role, we see the government is taking more actions on reforms and support economic growth. On Trump policies, our view is that it won't hurt Vietnam. The markets struggle to surpass the 1,300 levels we mentioned earlier for two main reasons. The first one was the foreign sell-offs. Foreign sell-offs play a significant role in weighting down the markets, significantly impacting investor sentiments and liquidity. Net foreign flows has been quite persistent since 2020, but in 2024 it's particularly become strong. The outflows in 2024 was 3.5 billion US dollars, the largest annual amount in the past decade. The second factor was the depreciation of the dong. Throughout the years, the stock market has showed significant sensitivity to the fluctuation of the currency. The red line is tracking the market performance of the VN Index, and the gray line is showing the Vietnam dong value against the US dollars. What this means to us is that in January this year, we think there is possibility of the DXY index to getting higher when Trump returns to office. This will put stronger pressure on the local currency, the VND, and subsequently it will put higher pressure on the stock markets in the first quarter of this year. Let's take a brief look at the sector performance last year. Sector performance showcased notable disparities. Information technology emerged as the best performing sectors, delivering an impressive returns of 56% in 2024. This follows a strong return of 40% in 2023. IT cements its positions as the market leader for 2 consecutive years. Consumer discretionaries also excelled due to very strong earnings rebound of some of the top consumer companies. Banking, materials, insurance, and healthcare also show strong performance, driven by the same recovery story. Negative returns from the real estate were primarily driven by Vinhome Vingroup, shadowed by the bigger than expected loss of VinFast, a subsidiary company of Vingroup. Brokers declined mainly due to weak liquidity and weak market sentiments. We look at the past, but it's more important for us to look at the future and what will drive the performance in 2025. We divide the catalyst for the market to go up in 4 main groups. The first one is the potential for Vietnam to be upgraded to emerging market status. This could attract significant capital inflows. Second, the government supports. Government ministry reforms is an important catalyst for economic growth in the long term. But we think it might take until the second half of this year for the new system to be up and running, together with keeping a supportive monetary policies. These factors will continue to be a foundation to support the corporate growth and corporate health of the economy in general. The third is the momentum from the domestic markets. As exports are slowing in 2025, further push for public investment and the revival of the real estate are very important to fuel the growth to the rest of the economy. And fourth, the market's fundamental elements. As all of the sectors working well together, earnings growth will get stronger and the valuation will get cheaper. This ultimately the key factors to drive the market up. On the risk side, that could drag the market down. The consensus view is that geopolitics and Trump policies will hurt Vietnam economy. We don't quite agree with that view, but the stock market is driven by sentiments, so we put them there. Currency devaluation, as we mentioned earlier, there is a strong pressure for the currency devaluation in the first quarter and strong downward pressure for the stock markets in the first quarter of this year, as we expect. Interest rates, even if we only expect a minor increase in interest rate this year, this could potentially send a negative signal to the market. Vietnam is reaching a significant milestone, the potential upgrade to emerging market status. In November last year, 2024, the removal of the pre-funding requirements is a critical step in solving the two remaining issues that Vietnam hasn't met. We expect by September this year, 2025, FTSE Russell will announce Vietnam to be included in the emerging index. With that, Vietnam could potentially be officially included in the index by March 2026, 6 months after the announcement. We believe some active flows will come ahead, either before September's announcement or before the official implementations in March 2026. Earnings growth reflects the health of the corporates. This is what we look at, what we forecast for the year. Since 2020, the markets have seen many incidents, COVID, crisis, but throughout the years, we still see an average growth of about 15%. This is a testament for the economic resilience story of Vietnam. We forecast the markets to deliver an earnings growth of 9.5% in 2024 and up to 20% for 2025. This is based on VNET Capital's coverage that represents 94% of the wholesale market cap. It's worth to note that we are talking about core earnings, not reported earnings. Core earnings is reported earnings excluded one-off items, and we look at core earnings to really see the true healthiness of the corporates. To speak in terms of the reported earnings, it would translate to about 16% growth in 2024 and 15% growth in 2025. This is a colorful slide and actually the most important slide in our presentation. It shows further details of the previous slides, breaking down the growth into the sectors in a heat map. As you can see, the sector is kept in the alphabetical order for simplicity. We see in 2025, every single sector except brokers is growing at double digits. This marks a pivotal year for Vietnam because all of the sectors have moved beyond recovery stage and going to the growth phase. Growth momentum has been disrupted before by COVID pandemic and then bond and real estate crisis. They are more red on these years, but moving from 2024, we see some of the negative growth of the sectors, but in 2025, all green, almost green. This is giving a strong message that Vietnam is going back to its potential growth. Now let's touch base a little bit in terms of valuations. As the growth has been expected to be strong, Vietnam markets continue to be traded at a discount compared to its historical average. Over the past decades, Vietnam's economy has undergone significant transformation, placing it at a much better position today. Despite of the progress, valuations remained largely unchanged. Looking ahead on 2025, the forward PE level is at 11 times PE, one standard deviation below 10 years average mean. Given the factors mentioned earlier, we believe there is a strong ground for re-rating. This data is from Bloomberg, just to show Vietnam in comparison with other countries in ASEAN. The PE forward level remained lower than most ASEAN peers. The discount has been narrowed, but it remained at 15% below the average. Investment themes, what do we like? Our themes this year will be more domestic focus. First, digital transformation remains a cornerstone of growth. With increasing adoption of software integration and AI data service, these themes offer immense opportunities across IT and related sectors. Second, real estate recovery is gaining momentum, supported by better approval process in terms of the new projects and infrastructure development. These themes extend to construction materials as well. Public investment growth is another critical driver. With a focus on infrastructure development, construction materials is well positioned to capitalize from increased public spending. Finally, domestic demand recovery is strengthening, with retailers expect to benefit from rising consumers' spending and improve economic conditions. We also like banks because of their strong fundamental and attractive valuations. This will be provide a solid case for long-term investments. These are the themes we like. Just want to note that we are high conviction investors. Our portfolios are built on careful stock selection. Our college now will open the floor for Q&A, and we welcome all of the questions from you.
Okay. All right, so here we are, and as the screen says, if we're not blocking it completely, please type questions into the chat function. So I've got the iPad here, and there's already several questions, but obviously we'll try to get to all of them. Now, just to reintroduce, obviously people saw Mike. This is Tu Nguyen. Tu is the head of our listed investments, manages the UCITS portfolio, our Cayman portfolio, and our local funds, and Can Vu, portfolio manager of the Vietnam Opportunity Fund. So usually in our quarterly webinars, we get a lot of product questions, so we thought we'd bring them up. All right, and of course, we'll start with a macro question. Sorry, that's the one that came in. Okay, so here's a question for you. Would a depreciation of the Chinese yuan hurt Vietnam? And by the way, I guess maybe another question is that a likely occurrence as well?
Okay, very good. Yeah, really interesting. So first of all, about the likelihood. So I mentioned in my presentation this dynamic about that it seems obvious that the target of the Trump administration is really China and Mexico, and I showed the chart of the Mexico. The dynamic with the Chinese currency is more complicated. What we saw yesterday is the second biggest intervention by the People's Bank of China into the FX market, second biggest daily intervention in history. So they do seem to be making an effort to try to support the currency. So it's not obvious that there will be a big depreciation. So we do get this question occasionally because of the idea, I think the idea that people have in mind is that if China were to depreciate their currency, that would make Vietnam's exports less competitive versus China's exports. And we do see that there is kind of a sentiment impact that happens often. When the Chinese currency depreciates, people here get nervous and they think that the stock market may sell off, the dong may temporarily sell off from sentiment point of view. But actually, from an economic point of view, this is a really big misunderstanding that a lot of people in Vietnam have, because Vietnam's competitive advantage comes from the fact that wages in factory wages are about half compared to China. So even if the Chinese currency were to depreciate, maybe even something like 10% versus the dong, it really wouldn't hurt our economic prospects here. And then the very last thing I'll mention is that we have a huge trade deficit with China. So basically, and I mentioned in my presentation, we import production materials. Well, if the Chinese yuan were to depreciate, that means that the cost that we would pay for those production materials would go down. So it would actually increase the profits of the factories here.
All right, so we're getting a lot of questions that are coming in. This one's more to two, but KV, this may go to you. So the question about the UCITS fund outperformed the index by 10% last year and has a good long-term track record. So we talked about macro, Lin Vu talked about the market. If you look at 2025, is the opportunity to generate alpha the same as it was in previous years, or is it changing?
The market has not changed as far as we are aware. It's still, by and large, inefficient, and there are still many opportunities for us to make money for our investors by picking the right stocks. And we have people like Mike and Ling work around the clock to help us find those opportunities. And as you pointed out, our outperformance versus the broader market has been quite significant, not only over 1 year, but also over the longer horizon. So it means that as far as the market has not changed much, we will continue to be able to generate such significant alpha.
All right. And here's a question that comes in from Daryl about a company I don't believe we own in most of the portfolios, which says, how big is VIC in the index?
Vingroup.
Okay, Vingroup used to be really large in the index.
Yep.
It has, recently reduced its weight in the index, and we do not have it in our portfolio, and therefore we've not.
Yeah, I mean,
Vingroup
is what you would call as a classic conglomerate, right? I mean, it's a conglomerate, a holding company, a parent company. Beneath that, they also have other listed companies like the Vinhomes, which is one of the largest real estate developers, Vinreal, which is the mall operator. So, at least, how we look at it from our portfolio allocation perspective, we do hold Vinhomes. We do like that exposure to the real estate sector, and we believe that Vinhomes has been the largest company in the real estate sector. That's an allocation we have. We're not holders of the conglomerate. Right?
And that's, we'll just read into it when people ask us questions about VinFast. A lot of it has to do with VinFast being a cash drag on the parent corporation. So, KV, we'll stick with you. A question just came in, not VOF specific, but I think it should go to you, which is, how come healthcare suffered in 2024 in terms of earning growth? It's supposed to be, or at least it's viewed in many areas of the world as a defensive sector. We own lots of hospitals and VOF. What's the outlook there?
Absolutely. And I think this is, before we sort of get into the earnings growth in healthcare, why is it an important sector in Vietnam? Healthcare is an area where, as you see rising incomes, rising middle class, that amount of disposable income that goes into better healthcare increases. If you think about sectors like healthcare and education, the allocation to the average salary in Vietnam is quite significant. Vietnam's about 10%. If you look at the regions, only about 6%. Education's about 15%. Now, healthcare in 2024 took a bit of a hit because, if you recall, we came out of COVID when everyone was at home. There was sort of a pent-up demand for inpatient and other healthcare services. There's a high awareness of healthcare services. Now, of course, that sort of bump meant that we had a very good period after COVID. Last year is a base effect. Last year is we're coming off a very high base, and so therefore we've seen performance in general, and within our portfolio, we have 10 hospitals in the portfolio that was impacted. The view, though, what is important is that the earnings growth and that the average earnings growth, the CAGR, the compound average earnings growth over the past 2 years and the next 2 years for the healthcare sector is actually holding very well. And it's the case that we have sort of backed in terms of our investment. We're looking at about 8 to 10% earnings growth on average for the industry our portfolio, we're seeing, of course, a lot higher earnings growth there.
All right, terrific, thank you. Michael, I think this one goes to you from our good friend Pierre. Do we see China increasing its manufacturing in Vietnam due to Trump? And how do you factor that into your growth forecasts?
Yeah, absolutely.
And by the way, I guess the question is, if it was coming in from someplace else, does it change the way you factor?
No, it does. Money's money. Yeah. No, this is it's huge, and I think I showed on my presentation that the biggest trade corridor of increase or growth over those last years is essentially China exporting production materials here. We make the products, export them off to the U.S. The Chinese moving factories here is just a different version of that. And our FDI is around 5% of GDP. FDI inflows every year. Chinese are now part of an important component of that. And this is it's a big deal. I mean, this is going to be for the next.
Yeah. So kind of as we began to talk about maybe 4 or 5 years ago, the whole China plus one strategy. Yeah. I think the big shift over the last 2 years has been a lot of that China plus one is now actually coming from China as opposed to from some other countries diversifying away. Yeah. It's now coming from China.
Yeah. In fact, we talked about this over the last years that. Initially, it had started happening actually before all the trade war stuff organically, just because the wages were lower in the China plus one, and then the trade war really accelerated it, and now we're just kind of moving up the value chain and making more complicated things here.
Terrific. And this question came in for you. So, as you think about the conversation that we've been having, both from Michael and Lynn about the economy kind of evolving, at least last year, from much more export growth to much more domestic consumption. Has that necessitated an adjustment in the portfolios, or the portfolio is already built that way? And what, if so, what are you doing at the margin to drive performance in 2025?
I mean, from the market's point of view, the market already comprises of more domestic-facing companies than export-oriented companies. For us, we do like the themes that include both exports as well as domestic consumption. And given Mike's forecast of the rotation in the economic drivers of this year, we are looking at fine-tuning our portfolio weights for the year. Nevertheless, I must point out that we're very confident and have high conviction in the top holdings that we have in the portfolio, and we do not expect that to change significantly through the year. And if you look at the top holdings of our UCITS fund, you'll find the majority concentrated in the domestic-facing economy, but also 1 or 2 names that are in the port sector or industrial parks that cater for the FDI/export sector.
So historically, the portfolios have been very concentrated. I know VVF is about top 10 is probably close to 60% of the portfolio. In the economy that we're going to have this year, do you think you'll still have that kind of top 10, 60% high active share, or do you broaden that out?
No, we'll definitely stick to, the original strategy, which has always been the high concentration and high active share. Because, and come back to the question just now about Vingroup, because the reason is we do not look at Vingroup. It's not even part of our investments universe, and therefore I don't know how much weight it has in the index. It's just gone down, but it's not relevant to our investment decision. Yeah. So yeah, still very much high concentration in the top 10 holdings.
Excellent. I think that's important because we continue to talk about the Vietnam opportunity. The beta is good, but it's about alpha is what we generate. The beta is, this is not a market to be passive. This one comes to you. You're very positive on infrastructure investment for 2025. Don't you think, and I'm quoting somebody, this is not my view, don't you think the administrative state reform could slow down the tendering and permitting this year?
Yeah, this is a great question. And I'll go back a little bit to that whole thing I mentioned about the countries do what they have to do, not what they want to do. Administrative reforms will be wonderful for boosting the GDP growth in 2026, 2027, et cetera, like that. It's a very interesting point that that you're making is, could there be kind of a J-curve type effect, that initially there's a slowdown before things pick up? Ordinarily, I would say that's a very astute observation. However, keep in mind the other things that I'm talking about, which is that the economy, you have the backdrop is that you have very big forecasts at the same time that people, policymakers, have not really fully understand this dampening effect, the spring effect that I kept talking about with the exports. So the confluence of those two, very big forecasts, slower than expected growth of exports, means that they're going to turn the two dials up. I mean, whatever it takes, they're going to make both of those go faster. I think in the 10 years that 15 years I've been here, I've seen over and over that the government is very, very good at taking very concrete actions when they have to. And to meet their objectives, frankly speaking, this year, they're going to have to.
Okay. And that's what we talked about. So last year, the economy started slowly, about a 3.1%, I think, in Q1.
In the beginning of the year, yeah.
And then the government started pulling the levers.
Kicked it in, yeah.
Okay, and then because export's strong, so manufacturing's so strong, they kind of took the foot off the gas. This year, you think they'll need to contribute more?
Yeah, but the template of what you're mentioning last year, where you start off slow and then they just do whatever it takes to get things going again, and then fortuitously they had the export story sort of pick up. But I think that's a good way to look at it. Yeah.
Okay. So Khan, the question came in. So you talked a bit about healthcare, why you're kind of positive on that. What other, from a VOF perspective, what other sectors? And I know it's bottom up, but what are the opportunities that you're looking at today in terms of adding to the portfolio, or are there things already in that are kind of your most favorite ideas?
Yeah, I think if you pick up the idea that Mike said earlier about 2025, it is a domestic story. It's a story around the consumer and that consumer confidence improving, spending. We have been in recent years underweight the consumer sector, but today, if you look at our portfolio, we are about 16% allocated to consumers, and if you add healthcare, that's another 8%. So it sort of makes up perhaps the largest allocation in our portfolio if you bring in sort of healthcare as a way to play that sector. So for us, last year we added quite a significant amount more to the portfolio into 2 listed companies. They are in the consumer space. And I think this year we will continue to look for opportunities in that space because, again, we are believing this belief that the Vietnamese consumer is really what we're investing in.
All right. So Mike, this question goes to you. And if you don't have an answer,
okay.
That's okay. So this is a good client of ours, so I'm going to ask the question. I know. So Mike, compare the benefits for India and Vietnam expected to gain from Trump 2.0.
Right.
Are these benefits the same?
Okay, not only do I have an answer, but Eric will not like the fact that I could talk about this for 1 hour.
And just to be clear, he won't. He won't.
Look, Vietnam is doing the East Asian development model. Okay, so we are focused on the production of manufacturing products to export. For India, it's really a story about making products that are primarily for domestic consumption. So it's true that, sorry, let me step back a little bit. The global trading system, when we think about everything that's happened with globalization over those last 30 or whatever years, India didn't really participate in that. So the story about India is more of like a story of domestic consumption and producing products for domestic use. So if you want to think about who has kind of the bigger beta, the bigger exposure to Trump 2.0, it's really Vietnam. India will do very good, but India would have done very good irrespective of whether Trump came into office or not.
It would do well, but that's okay.
Very, very well, sorry. Engineer math.
One of us has fewer degrees from Stanford. Okay, this one will go to you, but I think you guys can add if you want to. So let me mention it. So the government recently announced that they're going to do a significant streamlining, merging of government ministries, should make them more efficient. That was announced, I think, in November. Should have some. So too, as a portfolio manager, what do you think about the effect of, I guess, because it says the streamlining, it really hasn't happened yet, of the streamlining of the government's organizational process? Is that, are there specific sectors that mentioned here? Is that good for real estate? Is it good for the economy? I look at it as it's not about real estate, it's about a whole lot more, but what is your perspective as an investor?
Well, we think that it's very positive in the long term.
Yeah.
Although I think we do expect some transition period because things or big changes like that take time, but definitely very positive in the long run. And if the government becomes more efficient, it benefits everyone. The GDP growth would benefit. I think people are talking about higher numbers than Mike's numbers. Yeah. And I think if this transition happens smoothly, it will actually enable the GDP growth to be much higher.
I'll ask a follow-up because in talking to certain people about this, someone likened it to what, and obviously from the U.S., what a U.S. corporation would do, just a restructuring to become more efficient. Didn't have to do it, but it shows that the government is taking proactive measures to just get things done faster. Is that kind of the way you think of it?
You can mention Elon Musk's name. That's okay.
I wasn't thinking about that.
No, but I think that the government is genuinely interested in enhancing efficiency because they themselves probably see the bottlenecks here and there that slows down FDI, for instance. If things can be smoothened out and people can come in quicker, easier, there'll be more FDI.
This is a very big deal. I don't think people have understood how much of a big deal the streamlining is. But it's a big deal for 2026 and 2027.
Right, you know. and it was just announced, and so we haven't seen the effects of it, but I think the fact that it's happening, let's call it almost unsolicited, I think is actually important as well.
Very big deal. Yeah.
Actually, here's a question for you too that you may or may not like, but it's an interesting question came in. Is 2025 going to be a better year for small caps or large caps?
Oh.
And by the way, last year was better for large and the previous year was better for small. So
again, we do not look at our investment opportunities based on the cap categorization. We look at opportunities based on the own company's individual merits, investment merits, and including valuation. Yeah. So we see many opportunities in the market, and the cheapest sector actually happens to be the bank sector, and the banks tend to be larger cap. But to circle back to the portfolio, the UCITS portfolio, you see that our current year forecast for EPS growth for the portfolio is more or less in line with the benchmark, but our valuation is significantly cheaper. Yeah. So we think that we have both the opportunity of delivering the growth in line with the EPS growth, but also hopefully PE expansion for our portfolio.
Okay, this is a question I don't know where it goes. With the increase of disposable income, what's the outlook in 2025 for the insurance sector, which seems like it's lagged compared to other countries?
Well, the penetration rate is still fairly low here. So, yeah, I think we could bucket that in as kind of a general consumer type item and should benefit.
I mean, you could almost put that with autos or anything else that's a bigger ticket item.
The topic we were talking about before, healthcare, there is a discretionary component to some healthcare spending, you know, so we can kind of bucket a lot of that together. You know.
Okay.
But the key is, like many things in Vietnam, and that really has a lot to do with your stock selection, is the penetration rate is like absurdly low, I mean, compared to the region.
Michael, question comes in here. This is definitely for you. Can you describe more about Plaza Accord 2.0?
Yeah.
Is it feasible now with a different context?
So first of all, I have a paper on the internet, on our website, getting more into this details. Long story short, Plaza Accord 1.0 worked because the U.S. had troops stationed in Germany and Japan. And that's why the U.S. could say to those countries, hey, you need to cooperate with us to get the value of the dollar lower. And now, this time around, basically what the U.S. is doing is saying to China, which is not in good economic condition already, you need to cooperate with us to get the value of the dollar down, or we're going to put 60% tariffs on you. So it's kind of a carrot and a stick type thing. And I think there's a very good chance it's going to work.
So is it more bullying than negotiation, you think?
It's bullying. It's exactly bullying.
Okay.
Yeah.
And another question had come in earlier that said, if the tariffs do come in everywhere, let's just say, what would they do to Vietnam's GDP?
Wouldn't do anything.
Right. That's why. So if everybody gets tariffs, it probably levels everything.
Wouldn't do anything.
Vietnam's GDP is the same. Yeah. Just you basically export or import inflation to the U.S.
Probably not even that, but that's a whole other conversation. The last time around, there was no, well, remember, there was no inflation after the last tariffs on China. The thing to be really clear about is he has to do something. There's probably going to be 5, 6 or something % tariffs, and the impact on Vietnam will be nothing.
Okay. I don't know if I can say you heard it here first, but you probably did. Okay, this one to you. So there's been a lot of talk about the potential for EM upgrade from FTSE, likely announced potentially September, effective March of 2026. Okay. What companies will benefit? And if we know what companies will benefit, when do we think about positioning the portfolio to capture the flow that comes in, or do we just say we buy the best companies we can and not try to get in the way of the money?
Well, for our UCITS funds, we've always been looking for good investment opportunities with the consideration of liquidity. So when we look at the list of stocks that will stand to benefit from the EM upgrade, we see many of our holdings already. We see some additional companies that, although we know that the stock price may react to that positively over a short term, we do not intend to buy those companies just because the fundamentals do not justify.
And then likely they'll get even worse fundamentals if money comes in, P gets higher, and then someone leaves, and then you're stuck holding that. Okay, so.
Yeah, but sorry, the point to make there, I think, is to say that, we're not here crystal balling this event, this ascension. I think what's important is to be participating in the market. And whether you're a foreign investor or a domestic investor, there are still a lot of good companies. Do the diligence, back the right teams and the managers, and then position yourself now, rather than who knows, this could move forward or could be on time or delayed. Yeah. So.
All right. This question will be for anybody. So from a consumer confidence point of view, will we see an uplift in retail sales in 2025? Fashion, lifestyle, things like that.
Absolutely. Yeah. If you look at last year, I had a brief mention on that on one of my slides, but trying to cram in a lot of topics. We can think about last year that we started the year with confidence kind of a little bit below average, and then by the end of the year we had kind of come like a little bit better than average. What I expect, and by the way, at the end of last year was when you started to have an acceleration of confidence. And what I expect, I mentioned already, is that we were already in a positive trajectory for the consumer sentiment. So we was already going to get better as 2025 progressed. And the real estate, stuff that I talked about, the wealth effect, will make the sentiment even more. And right now, the percentage of people that are confident about the next year is around 75%. That sounds high, but it's actually a little bit low for Vietnam. And I think when we get up to around the 80s, that's when you're going to see these really discretionary, fashion-ish type items take off. Yeah.
Okay, cool. Well, I tell you what, we've already gone over an hour, which is usually we try to end in an hour, but a lot of questions came in. So I'll just ask each panelist, I'll go with you first, for kind of any closing comments to think about 2025. 90 seconds or less.
I think this year is going to be a roller coaster year, but I think we're going to end up better than what a lot of people expect.
But it won't feel good in the beginning.
Won't feel good in the beginning. Use that as a buying opportunity, and we're going to end the year much better than what a lot of people expect, I think, in terms of stock market and investment.
For the investors, I think we should be long-term. We should think long-term. So the market today is significantly cheaper than it used to be. I think it's like one standard deviation below 10-year average, and it's also significantly below the ASEAN peers. And we are delivering better earnings growth. Our ROE is also well ahead of other Asian markets. Profitability as well as return on capital for Vietnamese corporates are recovering from low base. So I think everything is very positive. And then the cherry on top would be the upgrade.
And by the way, ROE with not huge leverage, which is also
exactly,
important.
Yeah.
I mean, again, just to reiterate, the way we look at it probably is sort of a triangle. You've got good government policies, you've got improving corporate earnings, and you've got improving consumer sentiment. And those three things coming into play, working together, does feel like 2025 is going to be an improvement in 2024. And then if we're going to use a roller coaster analogy, certainly some people do like roller coasters. How we look at our portfolio construction and the companies in our portfolio, it's more like an aeroplane ride. Smooth takeoff, smooth landing. And that's really, we're trying to look at lower volatilities in how we construct the portfolio, but acknowledge there may be some short-term volatility that may be...
Turbulence?
Turbulence, I beg your pardon. That should be the better word.
Keep with the airline analogy.
But it should open actually opportunities to participate. And we stand ready. I mean, all of us here stand ready with liquidity in our portfolio to take advantage.
All right. Well, on behalf of the team, I just want to say thank you for everybody for joining the webinar. Thank you for your continued support. We got to most of the questions. I know we didn't get all of the questions. Hopefully, we can reach back out or set up a call with any of you. We should have this on our website by Monday. We'll have a follow-up link. But on behalf of the firm, thank you so much.